What makes an outstanding pension portfolio? Let me teach you. Let's go into the basics, which some people don't actually quite understand. They think it's about picking individual stocks. So I've put a report together which is based on our European model portfolio. Now, these can all go in your SIP or ISA, but they're European stocks. They're not UK or US, right? And there's several things which we've assumed, and you've got to be careful of. Now, first of all, you want a start date when you're looking at a portfolio to at least include a really bad time in the market. Because if you only cherry pick the best times, then how do you know whether those companies got a good enough track record? Equally, you don't want to go so far back that you're going back to since the start of the Second World War. Okay, so here, just as an example, I've taken 2022 up till the present time. Now, why rebalance annually? Don't worry about this too much. The whole idea is, of course, if after 12 months, I don't know, let's say you've got a stock like Rheinmetall and it's gone up 1,000%, you might want to sell some of it, or you might double down, but you can worry about that later. For now, let's just leave it as it is, and we've assumed reinvestment of dividends tends to be a sensible thing to do. Okay, so when we break that down, for me, this is an adequate number of equities and a 4% allocation in each. Now, strictly speaking, your allocation, according to academic studies, should be inversely proportional to the volatility of the stock. The more volatile the company, the less you hold of it. We've not optimized this portfolio. What we've done is kept it roughly equal holdings. You see one of them's got 8%, roughly equal holdings. Now, the reason for that is simplicity, lower bureaucracy, and because usually for private clients where, look, they've got maybe 500,000, 300,000, 100,000 in their pension, even if they've got 1 million, 2 million, it doesn't tend to make much of a difference, the added complexity of a bespoke portfolio. Remember, of course, your IFA or wealth manager is not doing any of this for you. I mean, they're shoving you in a basket with everybody else. This is bespoke to each individual when we create the model portfolios for them. So let's say you start off with $10,000. At the end, this has actually happened. You end up with $29,000. The issue becomes, are these companies worth holding going into the future, given how they've performed in the past? And more importantly, what's the risk beyond the fact that past performance is no guarantee of the future, which is a very